New York Fed President John Williams last night acknowledged progress in bringing down inflation and loosening up the job market, but don't get too excited because he insisted there is still more work for them to do.
I
This
think
next
that
Fed
that
meeting.
point is such an important point to make, is that the Fed does not want to see crypto rallying back strong. The Fed does not want to see the stock market up significantly. And all investing people, all commentators, all investors, they're going to look to the Fed to bail us out, because that's what we've been accustomed to doing for the last 12 years, 13 years. And the Fed's going to say, honestly, can't do that. We can't start printing again. So now you're in a sustained economic recession.
The markets depend heavily on the Federal Reserve's policies, especially the stock market and by extension the cryptocurrency market. Since the Fed started increasing rates, the markets have been stifled by credit, and this has caused the markets to decline. Now that the markets are rallying, investors are waiting to see if the Fed would continue tightening. Gareth Soloway, a seasoned trader and economic analyst, says we should expect the Fed to continue crashing the market. Would the crypto market survive the next Fed rate increment? What else should you be cautious about as the Fed plans to come out with its next policy in a few days? Gareth Soloway answers these questions and more in this video, so watch until the end.
Historically, when the Fed actually does pivot, the markets have actually sold off a lot more. So I think people have to keep that in mind, is that just because the Fed pivots doesn't mean all of a sudden bull market on again. I think initially you're going to get that reaction, right? People have been programmed to say, oh my goodness, this is fantastic news. But if you look at past scenarios where the Fed has pivoted, we've actually seen a significant decline in stock markets. .com bubble high, which was again right underneath 5,000, and then we bottomed out. And this is the part that, for me, when I look at the .com rally, it's very similar to what you see in the charts now. And it, being someone who's been through multiple cycles like this and not just zero cycles like so many investors, you have to be a little wary. I mean, to see a market drop from 5,000 down to 700-800 on an index like the NASDAQ, I mean, that's pretty scary. I think it's so interesting because I think we've seen some of these, like the Zooms and some of these other stocks, they've started to kind of bottom out, or at least it looks like that. But now you've been seeing like Apple rolling over a little bit more, some of the large caps starting to kind of be and to me, that's the final cycle of a downward move, is where you finally catch up to the strongest. The strongest finally get decimated. The Fed does not want to see crypto rallying back strong. The Fed does not want to see the stock market up significantly. In fact, I think it was 2 meetings ago where the initial statement from the Fed came out and the markets ripped up. And then Jerome Powell went to his press conference and he just said you could see him almost like looking at the market on his phone and then being like, oh, I don't want to rally. And then he just hammered the markets, and then the markets collapsed below that. So just keep that in mind, is that to get inflation under control, you can't have asset prices ripping higher, because the wealth effect takes over and everyone feels wealthier. They'll go spend more money, creating more issues.
Is the market in a short squeeze? It could be. Short squeezes are short-term spikes in asset prices, and it's usually very sharp and fast. We are seeing rapid rallies in both the stock and crypto markets, but it could be because of an influx of short sellers who are taking their money off the table because they are shifting their bets on the market and falling further. The problem with a short squeeze is, as the prices go up, these short sellers would soon return to bet on the price crashing down again, and the asset market price rally becomes crashing again. It seems we could be seeing the evidence of this short squeeze soon. There is already a growing sentiment that the markets would slow down, and there are good reasons for this. We could be seeing one of the sharpest short squeezes in recent times play out in the coming days. Gareth Soloway believes that this is what's going on, and we should not rule it out. One of the reasons why he thinks this is a short squeeze is because economic conditions have not really improved and the Federal Reserve is not ready to stop tightening. There is a conundrum here. The market is waiting for the Fed to drop interest rates before switching fully to a risk-on drive. Unfortunately, a strong stock market is indicative of a risk of inflation staying high. Therefore, the Fed would rather keep interest rates high so as to crush inflation. This would in turn take money off the table in the stock market, and the crypto market is unlikely to be immune.
My next case for downside in Bitcoin or crypto in general is the idea that we'll get some regulation out there that actually will help the case for longer term sustainability in crypto. But the next leg down to me is where you start to see the asset markets, like the stock market, really start to tumble when we do enter recession. And then the biggest question is, right, and I think we talked about this in the past, is when we get to that point, all investing people, all commentators, all investors, they're going to look to the Fed to bail us out, because that's what we've been accustomed to doing for the last 12 years, 13 years. And the Fed's going to say, honestly, can't do that. We can't start printing again. So Now you're in a sustained economic recession where asset prices, because the companies will earn less, are going to have to go lower. And that question is how much of that sell pressure in the stock market trickles in to the crypto markets. So I've actually started accumulating shorts on the S&P. I wouldn't call myself all in on my positions yet, but I'm in the camp that, I mean, we could go a little bit higher, but I do think that we're in a position here where we're going to see a bigger drop in the S&P. And I think this is, again, the same kind of thing. You're getting this asset kind of re-risking, if you will, people taking risk again, but we're now into some key levels on the S&P where I think you're about to see a bigger rollover and probably still trading down. I think this year at minimum we hit this 3,400 level, and then I think we could go down to this 3,000 level by late this year in 2023.
There are lots of grim predictions on what to expect in 2023, but even the positive ones are not so positive when you really think about it. For example, Goldman Sachs is predicting a soft landing, meaning the economy won't slip into a recession, yet their analysis predicts that the S&P 500 is likely to stay flat all through the year. Michael Burry had also expressed his opinion through his Twitter handle about the possible role the Fed would play as events unfold this year. He believes the Fed could pivot, and it would still not make things better. If they do pivot, it would only cause inflation to rebound. If they do not pivot, then we would have to accept that the markets could stay down until inflation is brought under control, and it is safe for the central bank to start easing again.
I think people have to look at the big picture, right? This is where you started to see quantitative easing at the lows in '09, and this is the run we had. And now essentially the Fed is pulling the punch bowl away. And is it realistic to think that all we're going to see is this 20% correction on the S&P 500? I find that hard to believe. I mean, again, the addiction to easy money, cheap money is now gone. I mean, look at the mortgage market, look at the housing market, everything that's going on there. It's collapsing across the board. And that's only going to get worse once people start to lose jobs. You know, as of now, job market is safe. I think that's keeping things afloat. You throw in a weak jobs number, you know, where we start to see people net losing jobs month after month, and things get very nasty very quickly. I think the most important thing to keep in mind is that, you know, the average investing age has dropped significantly. You've had so many new young investors coming in the market, partially through crypto, partially through meme stocks and trading that. And again, this all happened during COVID and work from home and money being piling up because people didn't have to go to work and all this stuff. And I think you have to keep in mind that the average investor has not experienced, you know, a long bear market in stocks. And that does concern me because it makes people think that, oh yeah, you know, maybe we'll have a dip, but we'll roar back to all-time highs in 6 months. And ultimately you've been through, you know, 2008, 2009, we've been through the dot-com collapse. And it's not, you know, there's at some point a reckoning period where we're going to really have a reset here.
One indicator that points to the fact that the economy may not be ripe for a rebound is the employment rate. Tech stocks have been linked with the performance of the cryptocurrency market. As we can see, the tech stock is rallying at the time cryptocurrencies are also going up. If tech companies are downsizing, then it means the industry is still struggling, and cryptocurrencies can also feel the impact when tech stocks start to dip. It is important to pay attention to these numerous indicators Gareth Soloway talked about if you want to invest in the equities market or the cryptocurrency market at this time. If you enjoyed this video, hit the like and subscribe button for more. Adios, and thanks for watching.